It's let me try this again. Oh, pause, stop recording. Okay. All right. Jay, how are you?
All right. Is the audio coming in okay?
Yes, sir. All good.
Yep. You already have some folks have joined.
How do we, if we queue up the Q&A, so should I open answer? I cannot queue up a person to say, put your questions here. So if someone would, as you folks come in, the Q&A is an area where what's helpful is as we're going through the presentation, if you have any questions, just feel free to put your questions there because if you have a question, likely someone else does. And that gets the conversation going at the end to answer questions that other folks might have. So we have got about, well, my watch tells me we've got a minute and a half to start, and my computer tells me we have less. Well, let's see. Got about a minute and a half, and we will start the recording and jump in. So welcome everybody as you are joining. We're excited for the presentation. Okie dokie. Let's see. Got about one minute. I'll just walk you through the Jay is gonna kick us off here shortly once we formally start recording. We have some prepared comments for the first 30 minutes, and then we'll follow up with some unscripted Q&A. Give it about 30 seconds, and we will get started. So, Jay, it doesn't necessarily when I hit the record button, it doesn't say otherwise you're recording. So I will sort of give you a cue once I hit this record button. Pause, stop recording, stop recording. Oh, geez, it's going anyway.
Yeah, Chris, I think we're already recording, which is fine. We have great editors.
Okay. All right. You are receiving. Okay. Cancel. Let me go back. All right. Give me. Says pause, stop recording. Pause, stop recording. Okay. It hasn't stopped. We've done this enough times. You figure I'd have it down by now. Pause, stop recording. I don't want to do that. All right, Jay, let me turn it over to you. We'll get started.
Thank you, Chris. The one challenge with technology, it helps us, but they keep changing it on us. And something tells me that's going to happen the rest of our careers. Welcome, everybody, to the July 2025 Economic Update from Vision Based Planning. Today's featured speakers are Chris Rawson and Brian Bly. First, here's why we do this for you folks once a quarter. It's very important that you understand that we care about you and your understanding and comfort level with the markets and our processes. If you haven't attended one of our quarterly updates before, it's action-packed, it is information-packed, and we do it because we want you to be educated as an investor. Our focus is to guide clients so that you feel confident in your long-term financial plans. So here's our agenda for today. We are going to talk about the domestic markets. We're going to talk about the international markets. We're going to talk about fixed income. We're going to talk about how we are applying the thoughts that we share with you today on your behalf. Chris is going to share some food for thought on some things he's seeing in the economy, and then we will open it up for question and answers. But first, we're going to start with the U.S. markets, and we'd like to break it down into the good and the bad. And Brian's going to kick it off for us with what he sees going well in the U.S. economy.
Thank you, Jay. So we'll first start off here with U.S. profit margins. As you can see here, they remain really good. And what's more important also is you can tell from the trend over the last 17 years since the financial crisis, the profit margins have been increased over the time. So a good trend. Companies, especially the S&P large cap companies, have been able to adapt and extract profit from their sales. And it's expected they will maintain their elevated margins as well as their strong relative earnings performance throughout the rest of this year. As far as next positive, we are still in an environment where job openings, which is about 7.76 million, still outpace the number of folks looking for jobs, 7 million. So we're still in a tight labor market. Since we last met, the actual job openings actually increased by 200,000, while the people looking for work actually decreased by 100,000. So over a quarter basis. So we continue to look good, especially with enforcement of the immigration policy. The unemployment should anticipate it will remain low as well. So we've got a real healthy, tight job market. Along those same lines, since we last met, this is a 3-month reflection. The black line is on this chart is a reflection of the 3-month moving average month over non-farm payrolls. So since last quarter, we were kind of in a downtrend, and as you can see here, the last 3 months, we are back in the uptrend again as far as adding non-payroll jobs. So once again, the labor market remains very good and very tight on supply. One thing of note before we turn over to a different area, just wanted to make note that wage growth, we don't have a slide on this, but wage growth has remained above inflation for the past 20 plus months. Actually, in June last official data we have, the wage growth was at 3.9%, so which outpaces inflation for those folks that are still working. With that, we'll turn it back over to Jay.
Excellent. Thank you, Brian. Hey, I forgot to mention at the top of the call, if you have a question, don't be shy. You can go into the chat, post it. You can even post it anonymously if you are a little bit shy. And I will pose these questions at the end to the team. Next, Chris, what's going on in the economy that we really need to put a negative lens on?
Yep. So the first component is inflation. So this is, let me break this chart down a little bit. As I'm looking at it, it looks a little busy. So you get to the peak inflation was June 2022 of 9.1%. So this was when it was the absolute highest. And everyone who's here, you're going to get a copy of this slide, the copy of the whole presentation. So these are the contributing factors. So energy was a large contributing factor at this time. So if you focus on these diamonds, it's coming down, 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 down. Okay, had been coming down. Well, now it's ticked back up a bit. So for example, you see here, I'm going to highlight this, June 2027, inflation 2.7%, which has gone up in the last 3 months since the last measurement date. And part of that is because of tariffs. And so what happened with tariffs and even the threat of tariffs is that companies, the term we use is called front running. They front ran the tariffs and brought a bunch of products into the country before these tariffs went into place. So you see net exports. So we're importing more than we're exporting. So that went up tremendously. You see this purple graph here. So because imports have a component to our GDP is gross domestic production. So how much are we producing? Well, if we're importing, we're not producing because we're letting someone else produce that for us. So you look at here, change in private inventories skyrocketed, meaning that if you want to get ahead of this price increase, you're going to increase your inventories tremendously so you can sell it at a lower price. Well, those inventories are starting to run out. Well, you're also starting to see tariff agreements, international trade deals. Nonetheless, we had negative growth in GDP in the first quarter, and that's just a simple reality. Uh, Long term, we see this a little bit as a blip on the radar, but it's important to know that our GDP was, in fact, negative in the first quarter. Okay, what else? Student loan delinquencies. This is something we've been waiting for. So you see student loans right here in orange. Historically, it'll range anywhere from just under 10% to over 10% in terms of the percentage. Okay, so here comes COVID. Student loans are not due. Now, as it goes down, they're in forbearance. Okay, they're skyrocketed. Student loans have skyrocketed. So part of the reason we host this event is to preempt the jarring headline for you to be concerned. It's a reality. Yes, student loans default delinquency is now 8.2%, but it's in alignment. And I'll just say, me personally, I didn't believe in student loan forgiveness because other people didn't get their loans forgiven. So we're starting to see the delinquencies rise because to a normal sort of space. All right, Jay, let me turn it back over to you.
Thanks, Chris. Let me summarize what we just went through as it relates to the US economy. Businesses are managing their profits and their profit margins in a very proactive way, and we continue to see growth, which is great for equity ownership in the United States. Labor demand is still out there. There are jobs if you would like them. There's some headline risk around that you see that just isn't really supported by any of the data that the team supported today or the team presented today. On the negative side, or really, we should say the cautious side, what we're watching is inflation. We've seen a recent slight uptick in it. We want to pay attention to it because that could impact portfolios on a go-forward basis. There have been some challenges around tariffs and the uncertainty, particularly headline uncertainty that come with the discussions around tariffs. First quarter GDP was a negative print, as Chris spoke about. Today, we now know that here in the second quarter, we're looking at a 3% GDP number, much more in line with the 10-year historical average and the growth of the US economy. And the last thing that Chris pointed out is going to make headlines. You're going to see stories about student loans and people struggling because now they have to repay their student loans. But the implications to your investment portfolios should be mitigated by the simple fact that we're right back to the historical 10, 15-year baseline we've been with delinquencies. So with that, let's shift from the US economy and start looking overseas. Brian, walk us through the good.
All right. So this chart here shows the outperformance of the international relative to the US and the US dollar. So you'll see a slight, I guess, a gray shading over the 2002, 2008 period, which shows a period of declining dollar, which is what we've got into here recently in 2025. So during periods of declining dollar, the international equity markets, the growth portion of your portfolios tends to outperform. There may be a little period of underperformance, but in general, when you have a declining dollar, the international does well. So what we're see here on the far right, you'll see the international underperforming the dollar, but as evidence of this international outperformance, for example, year to date, the international developed markets, you'll have a performance of about 19.5, and emerging markets are about 20.5, which is about 10% more than what we've seen here in the US, with comparing it to the S&P and NASDAQ 100. So this is a 3-year rolling, the purple is a 3-year rolling annual cycle. So even though we see it negative coming into this year, we've already seen signs of that in 25, where the international markets year to date is outperforming the US by 10%. So that purple line will start getting smaller and potentially get onto the positive, the above side of that line there. As far as unemployment is concerned, once again, we've looked at this chart before. developed markets outside the US, the Eurozone, Japan, as you can see here in the darker and lighter blue, they remain steady and below a 18-year historical average. So they're both on the decline, remain below the historical averages over the last almost 18 years. On a global inflation basis, all of the developed markets, as well as some emerging markets, the consumer price indexes remain reasonable. So you see here, of course, Russia and Brazil are high, albeit Russia came down. But below that, all the other markets, both the developed and emerging markets, are at 3.5% or below. Just as a note, since we last met, all the inflation rates have come down across non-US markets, with the exception of Brazil upticked a little bit. The UK went up by about 0.6%, and China went up by about 0.6% as well, even though China is still at a negative inflation rate. From a central bank perspective, everybody except for the ECB, which is the European Central Bank, the Bank of England, which is otherwise known as BOE, and the Bank of Japan, also known as BOJ, have had different rate policies. The ECB and the Bank of England have been cutting. The European Central Bank last cut in June. Now, they met last year and held rates steady. Likewise, Bank of England, as well as Bank of Japan, had their last meeting in June, and they held their rates steady as well. Now, the Bank of Japan has been an outlier because of their rising inflation. So you'll see they were at a zero or negative policy. They've increased theirs. While they've maintained steady since June, you'll see them raise rates because their inflation was kind of in the opposite direction of where ours was, where ours was coming down and theirs was going up. So that's the reason why they increased, but they have stayed steady at that 0.05 central bank rate. Now,
Chris, let's talk about what might be a challenge for investors as we look at the overseas economy.
Yep. And so, may not be a surprise, our first slide to present is tariffs. So we shared this slide last presentation. This is a JP Morgan chart. Originally, this orange line was almost off the charts. They couldn't even measure the rates of inflation. Now we've seen some agreements in place. There's an agreement with Japan, $550 billion investment from Japan into the United States, an agreement with the European Union in the last week. So the effective tariff rate here landing in the 15.2% range. So we can be hopeful about this, but still a negative and still contributing to inflation. It just simply makes things more expensive. Okay, tariffs. So these are our three largest trading partners: Mexico, and you see on the bottom here, China and Canada, to the tune of more than 2x, even Germany. So you see Germany is below $200 billion of imports, and here's Canada over 400 billion. So we do not have trade agreements yet with Mexico, China, or Canada, and certainly see that as a negative for now, sitting here in July of 2025. As you see here on the left-hand side, bad actors continue to work together. With that, I do think that there has been pressure. So we had an operation in Iran. There's certainly pressure on Russia here in the last week. So I think that there's pressure on the bad actors. The bad actors will continue to figure out how to work with each other. But I do think that there is some very clear pressure and influence on some of these bad actors. Before I turn it over to Jay, It's on my mind. I want to ask for feedback. I'm going to ask this at the end, but at the end of this presentation, you're going to get a pop-up. You may notice we changed the layout a little bit. So we want your feedback. We want to make this presentation as good as we can make it. So at the end of the call, please give us your feedback on what you liked through the presentation and maybe areas for opportunity. All right, that was on my mind, so I wanted to say that briefly. Jay, let me turn it back to you.
Excellent. Before we recap the international markets, there is a psychology term we use in the investment sphere called home country bias. So many investors over the past 15 years have developed a home country bias, meaning you believe that the performance of your own country will do better than the rest of the world. And it's very prevalent today because up until the start of this year, we've had extreme outperformance by the US markets. But what you know from studying markets historically, that trend does not continue forever. And we've already started to see that unfold this year as international has dramatically outperformed the US markets. That's why it's important to pay attention to both the good and the bad when investing internationally. Just to recap, on the good, we've seen the outperformance. The unemployment in the Eurozone in particular is low, and globally, central banks have been cutting rates since our last update. On the bad side, still uncertainty around tariffs and imports. There's no agreement yet with our three largest trading partners, not to be confused with the news that came out about some of the deals being struck in Europe today. It's those three largest that we really have our eyes on, and we got to continue, unfortunately, probably every call to talk about the fact that we're still watching bad actors across the globe and how they could impact our client portfolios. With that, we're going to move from international markets to fixed income investing. Chris.
Yeah, so as we all know, interest rates have been higher due to inflation. And so for good reason, interest rates have been higher. So what's good about higher interest rates? Well, it goes back to this term called clip the coupon. This term comes from decades ago when you would go to the bank and you would get a bond or a CD and they would literally hand you the paper perforated and you would clip the coupon, go down to the bank and you would receive your interest payment. Well, those current rates are here with this diamond. So when you look at things like, I'm going to draw your eye to the bottom left, US Treasuries, municipal bonds, investment grade corporate, mortgage-backed securities. How much yield are we collecting here? 4.2, 6.8, 5.1, 5.1. These are very good interest rates. So now that interest rates are higher, what's good about it is we can clip that coupon and get that. I think of it like shocks on a car. We've got some shocks, and so we can cushion any, jarring potholes, if you will. And we'll cover that a little bit later. But we've got good cushion. We can continue to clip that coupon for now. Well, it cuts both ways. When you have a federal budget that we have, which is deficit spending. So I'm going to draw your eye to the middle here. And our federal budget for 2025 is $7 trillion. Okay. Well, naturally, we spend from a deficit, meaning we sell our bonds and need to pay the interest on those bonds. Well, when interest rates are higher, our net interest is higher. It's more expensive for us to borrow. It's like buying a house when your interest rates are higher. So if you look at the bottom here, our net interest, our mortgage is like to call it, is $952 billion out of the $7 trillion budget. So roughly 14% of our budget goes to the mortgage. Interest rates will decline over the next, we'll say 24 months. And when it does, our net interest will go down. So when you look here from June of 2022, our interest expense when we had lower interest rates was $400 billion. So our interest expense has more than doubled since this time. And certainly that's a negative, and it would be better if we could figure out how to spend less. So likely this slide is not going anywhere. So let me, Jay, I'll turn this part over to you.
Chris, that's a challenging slide. I hope it changes someday, but that's going to be a big mountain to climb. Fixed income can be very confusing. Chris nailed it in the beginning. Today, because of interest rates on our fixed income investments, we're able to, quote, clip the coupon, which is take the interest payments from the different fixed income investments we have in the portfolio. So that's where we focus on as it relates to the good inside of the fixed income markets. On the bad side, deficit spending is something that we're going to need to continue to watch. Now, stay tuned. Later today, we're going to get news from the Federal Reserve as to whether they are going to lower interest rates. Now, let me just make sure we understand what we're talking about here. When we say the Fed is going to lower interest rates, that is just the short-term borrowing rates that the Federal Reserve has control over. They don't have control over your fixed income investments, the 10-year Treasury or the 30-year Treasury. They're talking about if they're going to lower the short-term rates. I already see in the question queue, we have a question about that when we get to our Q&A. Next, let's talk about some things that Chris has on his mind. How are we? Oh, I'm sorry. That's not correct. Let's turn it over to Brian to talk about how we're applying all this to your portfolios.
All right. Thanks, Jay. So this chart here shows the business cycle. So as you can see on here, these early, mid, late, the non-recession, globally, countries, regions are in a expansion phase. If you see on the far left, China, Eurozone, and Canada are developing momentum to come into an early cycle as far as the business cycles goes after being in a soft patch. So overall, internationally especially, as you see there are China, Eurozone, Canada, Japan, and then with Australia and Korea and India a little bit further back in the late cycle. European international is going well. So last quarter we mentioned, indicated in our presentation that we would potentially migrate towards a higher international allocation. And as you all probably had recently received email, we have actually implemented that change. So we shifted for those that in your growth portion of portfolios, we have shifted a bit from the U.S. to international, and that also goes in sequence with what we looked at earlier with respect to the U.S. dollar and how that's migrating over, becoming a little bit weaker, and internationally picking up. So we have migrated that shift on your growth portion a slight bit over towards international. For your fixed income or your conservative portion of your portfolio, we've not made any changes, and we'll continue to monitor manage the duration as we monitor any changes in interest rates moving forward throughout this year and into next year and beyond. So with that,
all right. So
turn it over to Chris for food for thought.
thank you. So I'm gonna leave you with some slides that are hopefully you find impactful. Again, interested in your feedback. So roughly 3 months ago, I remember looking at this slide. So here this is a slide from JP Morgan, and it shows the S&P 500, and in red is what they call the intra-year decline. So how much does it go up? How much does it go down? And where do we end the year? So the bar chart is, if all you did was look at it on January 1st and December 31st, what's that number? So far this year, the S&P 500 has gone down 19%, come all the way back up, and ended at 7%. So a 26% return round trip in the last, well, 6 months. This is as of July 23rd. So interesting slide. And I can remember sitting here going, I think we will at least break even. And here we are in positive territory. So let's build on that. And this is a slide from First Trust. So this is also showing us the S&P 500, but it's showing us what is the type of decline: 5% or more, 10% or more, 15 or 20. The last time we reviewed this slide, these were, well, there was some dip in March, but now you see April. Well, we passed it in April, -5. We passed -10 in April. We passed -15. But then here, this is interesting because we were preparing for the call. -20% was from October of 2022. And then this will give you the frequency. Every 16 months, every 3 years, every 5.5 years. So if it was 1% different, every single one of these would be April 2025. So just sort of interesting numbers, and thought this would be a helpful slide. Okay, another chart from JP Morgan. We call this the quilt chart, just like you know, a quilt on the bed. So I'm going to draw your eye to the top right. So here's year to date. What you see here, and Brian referenced these returns earlier. This is developed markets international, positive 20, emerging market equity international 19%. Okay, well, what's on the bottom? Cash. Cash is the worst performing asset class year to date, paying 2.4%. So the other reason we host this call is to break, and even Jay referenced our biases. So we all have our own biases, and some of these biases, because interest rates have been higher, is to say, I need to keep and hold on to my cash because I can get a 4% on my high yield cash. Well, keep in mind that's taxable, so that's not take home. And when you look at these different asset classes, as you think about your goals, it might not be the best with the decision to hold on to your cash if you have longer term goals. So interesting chart. And so then if you're thinking, okay, well, I'm going to put my cash in, but what if it goes down right away and maybe the ship has sailed? It's sort of, we're at this peak. Okay, this is a JP Morgan slide. So the percentage of the days the S&P 500 reaches an all-time high, it's 6.7% of the time. So 6.7% of the time, new high, new high, new high. And maybe we're wired this way. We're going, oh, I don't know about that. New high, I'm not so sure. Okay, the next, the percentage of the all-time highs that are the floor is, call it 30%. So it's going to go up, it's going to go down, it's going to go up, it's going to go down, it's going to go up, it's going to go down. 30% of the time, when you hit that all-time high, it's now a floor, meaning that you don't have to worry that the ship has left the harbor, in a sense. It's really about your goals. So at what time frame do I need these proceeds? At what time am I going to be taking income? Or when is this goal, if it's a specific dollar amount in time frame? And again, the reason we host this call is to preempt or prevent what's in here from doing things that are in your best interest. Okay, last slide. And this is related, unrelated, interrelated. This is a slide, US net imports, okay, all the way back to 1967. And now that I'm in my mid 40s, I remember being a kid. We need to get off this oil. We're dependent on all these other countries. They have influence over us because we're dependent on their oil. Well, guess what? We are now energy independent. So you see down here, our oil imports are negative. We are exporting US oil out of our country. We're exporting oil out of the US, and there's no victory lap. So this is the victory lap. Where's the victory lap? We're energy independent. We are not dependent on foreign governments for their oil. We're sending it out the door. Unbelievable. So victory lap. We can all brag on our friends and enjoy the victory lap of the fact that we're energy independent now. All right. That's the food for thought. Jay, let me turn it over to you and see our questions here.
Yeah, absolutely. Great charts. Energy independence really is incredible. You're right, Chris. I'm surprised we don't see more headlines about that. Reminder, if you have a question, jump into the Q&A portion here on the Zoom. I'll post it to the team. I'm going to start with the first one. Last year, it was widely believed that we were overdue for a correction. Was April the correction that we were waiting for, or is there another one that will last longer than a few weeks? Team, what are your thoughts?
Brian, I'll let you take this one first.
Well, it
See
really
if I
depends
can go.
Yeah, sure. So it really depends on your timeline. Like and like Chris has shown here in that one chart, well, if you go to the next chart, I mean, there will be a correction at some time. I'm not answering the question, I'm not trying to avoid it, but when it'll happen, who will know? So you can see right here on this chart here, 5% or below happens almost every 3 times a year. So every 4 months, 10% or more every one and a third year, and then 15% more every 3 years. So eventually we will hit another patch where there will be a correction. Do I anticipate anything anytime soon? Not really. We're not predictors of the market. Barring there may be some extraneous event, like we've had in the past where like when Russia invaded Ukraine and of course COVID and stuff. So there's extraneous events that you and we don't have any control over, but as we've seen, the market recovers. So it's all about your long-term planning. So there will be some correction sometime in the future. Do we see something in the rest of this year? There's nothing, at least that I see, absent any type of big surprise that comes out on a global basis.
Yeah,
Chris,
I would
any
agree with
thoughts?
that.
Yep.
Yeah. So for example, like if you look at even looking at this chart, so if you look at all these red dots, every year, let's just take the S&P, every year the S&P 500 is going to go down. It's to what degree that it goes down. And then if you just look at these bar charts, how many times, so annual returns were positive 34 out of 45 years. So for example, 70% of the time, you're going to have growth. You're going to, and what I share with clients, you will be in positive territory twice as often as you're in negative territory. I think Brian made a good point. It depends on your time frame. And to answer the question, overdue for a market correction, yes, the technical definition of a market correction is greater than 10%. So we had 19% this year. You look at last year, -8, -11, and then here, 2022 is a nightmare. It went down 25 and ended down 19. So, but then what happens the following year? Down 10, up 24, down 8, up 23. So, yes, I do not expect additional downturn for the second half of the year.
Next question. Why does the president want lower rates than the Fed?
Well, I guess since I was talking about that I guess if I were to unpack that in a couple of ways, the first question is he acting in his own best interest? Is he acting in the country's best interest? Okay, I think he's acting in the country's best interest. If he's acting in the country's best interest, what lower interest rates do is it allows companies to borrow at lower rate so they can spur additional growth. It'll also drive the real estate market. So if you lower interest rates, so for example, there's like a supply of homes now because they're just expensive. When you look at the interest rate and you look at the price of real estate, it's tough to buy a house because those interest rates are going to factor into that monthly payment. Plus I just think he likes to sort of bash on stuff. And so, but do I think interest rates should be lowered this afternoon? No, I think they should be the same. Is this going to be a golden opportunity for him to hammer Jay Powell? Absolutely. Okay, but it doesn't mean he doesn't know what he's doing. He knows quite well exactly what he's doing. And part of it is policy uncertainty. So, for example, if we had a deal with China, Japan, China, our largest trading partners, interest rates may go down. But we have a trading deal with Japan. We've got a trading deal with the EU, not with China yet. So if he were to sit behind a deal and go, "Hey, Jay, why aren't you lowering interest rates?" He goes, "Look, Trump, do a deal with China, lower interest rate, lower inflation, and I'll lower interest rates." It's like, give me something to work with here. So why does he want them lower? Because the guy wants what he wants, and that's fine. Lower interest rates will drive the economy. But we need more agreements.
Yeah, and one thing to add to yours, Chris, is you see there on the bottom left that net interest number, the 952 billion that Chris mentioned earlier. lower interest rates will eventually mean we're paying less on our country's mortgage, so to speak. So the net interest amount we pay with interest going down would actually decrease over time. So then we would be in a less of a deficit spending situation. So the total spending side would come down, looking at net interest only, and then therefore the sources of financing would also come down to balance the budget. So there's, in addition to what Chris said, it's also to help make the budget figures work a little bit better.
All right, next question. Brian, I think I'll start with you on this one because you addressed some of this in your comments. Are we planning to change to the domestic markets since it seems tariffs have not negatively impacted the domestic markets?
So as mentioned before, we're in a cycle with international is looking more in a positive light. This chart we showed right here with respect to Eurozone, Canada, and China coming into a early expansion phase. Japan holding steady, still climbing the peak of the mid expansion. In addition to what we looked at in the earlier slide with respect to the US dollar, international is actually looking to be more promising from a growth perspective and your growth portfolio perspective. And so we have shifted a small portion over from US to the international, both developed markets as well as emerging markets.
Chris, any follow-on thoughts, or did Brian cover that question?
I think this is this question here, and then as it relates to the US,
International versus US.
Yeah, well, and so but you see here the US is at 8.9. So we're still doing quite nicely in the US, albeit not as well as the international. And I think, Jay, you made a great point earlier, which is country bias. So we still have some country bias. We do have more US exposure than international. Interestingly, as we continue to meet with our clients and the portfolios in Europe are exactly the opposite. So they have country bias. All advisors in Europe suggest a larger weighting for their domestic versus our international. So I feel really good about where we are with our international exposure and our US exposure, because I think as some of these agreements come to place, we haven't talked at all about this tax bill, which I think will grow the economy as well. We've got some additional talking points, several specific families that have opportunities to take advantage of this new tax law from July 4th. But I do see that growing our US economy. Part of lowering our deficit is growing the economy. If we can grow the economy, we'll collect more tax revenue simply with a larger economy, and that will naturally lower our defense spending. So I feel very optimistic about directionally where the US is going.
So a follow-up question when we look at the US versus international from Susie is, how is China's fast-pacing economic growth factored in to the portfolio construction strategy? How are we looking at emerging markets today? Is the core of the question, I believe, Susie.
Yeah. So mentioned with the increase in international, that's both in developed markets as well as emerging markets. And China is actually considered part of the emerging markets. So we've actually increased across the different portfolio models, risk models we have. We've increased both emerging markets as well as international. So to answer the question, the fact that China is coming out of a soft space and starting to re-blossom again, at least the signs are that we've increased that emerging market exposure, which includes emerging markets is a good portion, includes a good portion of China as part of that allocation.
Excellent. Awesome. Last question. Again, here's your final opportunity to submit questions if you have them. Last question. So if I'm sitting on cash in a savings account, earning 3-ish% interest and don't need it for a few years, say 5 years until retirement, Should I be investing in the markets instead, assuming that means equity markets? Chris, I'll turn it over to you. What's a good thinking framework for that?
I would say yes. And so, for example, and of all the families that we work with, there's a range, and we use our Riskalyze tool to say, okay, we call it our sleep at night factor. So it'll go up, it'll go down. But the other part about it is, even if retirement's 5 years from now, I think about retirement like, well, my kids are 17, they're going to senior year. So uh, when you graduate, that's commencement. So retirement is like you're graduating from that part of your career. Well, that's commencement. Well, what does that mean? It means it's just the beginning. You're going to be taking income for 30 years. So just because retirement's 5 years from now, how long do we need to generate income? We need to generate income for 35 years. So for starters, do you need that money right away? There are other risks as it relates to retirement, as for example, bad timing. So for this specific person, I'd encourage you to reach out. We can look at your plan specifically, because there are risks when someone goes from working to retirement, specifically bad timing, meaning that, we have a downturn right when the person retires and we need to take income from the portfolio. There are strategies to mitigate that. So with that sort of planning disclosure, just as I read the question and I'm giving you my protocols in my mind, thinking about what we need to do to make it make sense to recommend for this person to not just sit in cash for the next 5 years, my intuition is telling me, yes, we should put that money to work for you in a way that you would feel comfortable knowing that it's going to grow and it will come down and it will grow and it will come down. But you likely, just because retirement's 5 years from now, that's just the beginning. Um, so that's my full, I guess, start to finish thought process on that one.
Excellent. Team, we do not have any more questions. Viewers, please, there'll be a survey after we hit end on this webinar. Please, 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 we'd love your feedback, because we try and make these better and better each quarter and hope we can serve you the best of our ability. Everybody, thanks for your time.
Thanks so much. Bye-bye.